Hello and welcome everyone. This is going to be an XOM trade breakdown from the short off of 90. This is just a quick little review of summary of the prints and then some thought process behind the trade. So we're coming down to 90. There hasn't been any significant real off-level selling really all morning, and on this way back down, the selling has been at print personality or slightly above, which is maybe 2-3 burst, and then we start to come and see these 90-11 bids and some 46s, some 28s started to pick up here above 90, and then you got these 90-01s to 90. So these 90 are bid prints above print personality, and with those alone per rules, what that tells us for our calculations is that should pull up approximately 50 cents to be conservative, and ideally $1 on that bid position for that market maker to build on their position. However, as we see, there's a reaction immediately after that. So that's 89, 88, some great selling, and then some more great selling 89. So, and then some more great selling at 79. So the thought process behind here, that is our dominant market maker at 90. That's what we're basing the trade off of. That is a market maker. That's a dominant one. And then as we proceed, these are some market makers that react to that. So could be the same one, could be others. Most likely it is others, smaller market makers that have a similar game plan and they working together and aligning. With this selling under here, the thought process here is, why would you sell that significant under 90 when these 90 bid prints alone and that market maker told you that statistically they need to build in that position and pull it up? So why wouldn't you wait to sell this position at $1 higher? It just doesn't make sense in that instance. So with that thought process and seeing the reaction of other market makers coming in around that 90, which therefore really our thought process for the pull up and the time frame of that pull up is going to be a lot less. So this 90 happened approximately 11:10. So on this initial break here, came back to the 89.50, and then we got to pull it back to 90, and then it triggered down for the clean short. So we can anticipate and expect a trigger off the 90. Ideally, yes, it does pull up to 90.50, makes our percentages higher, but statistically with what we saw the other market makers react, there's a few other market makers that reacted to the 90s. Those market makers aligned with the understanding that this is going to be a shorter pull up and then a trigger back down for the money time. Perceive these other reactions as short traders coming in and understanding that this is going to be a move down first before the overall building period from 90. So with that being said, your calculation, if you're a student, you see those 90, yes, you see 90.50, but your calculation can also be shifted from other market makers that react to the dominant market maker, right? So that's kind of the thought process between a good trader and a great trader. A great trader can understand, okay, this is what the calculations say need to happen based upon the controlling dominant market maker prints, but they look further. They look into, okay, what are the reaction? What are the following market makers indicating? And are they aligning for a specific type of trade? If this trade would look vastly different, if there was absolutely no selling above or below or bids above and below, if there wasn't any market makers reacting to this 90 bids, this chart would look vastly different. And your expectations would be, okay, that pull up you'd be looking for number 3 for that pull up trade to 90.50, even 91, rather than when the market makers showed the following market makers showed their hand, you're looking for the number 2 short trade, and you accept and you realize that the pull up's going to be a lot less, the time frame is going to be a lot less. So your expectations change here. So that could be the thought process of a number 3 versus a number 2, and that's the difference between a good and a great trader. A great trader can understand that the reactions of other new market makers around the dominant market maker suggest that the pull-up is going to be very limited in scope, and then we're going to trigger down for a number 2 short trade. And a good trader would be like, okay, I can't touch this, or I'm going to take a number 3 trade till 90.50, or I can't touch this till it pulls up X amount. And that's all good as you're a learning student and you become as you progress. That's good to set that foundation as a beginning student. But once you start to progress, you really want to dial in and understand when a stock is not going to give you that full calculation and when it's going to be shorter time frame, or when it is going to give you that calculation. Like I said, if the reactions weren't there, the expectations would be that number 3 if there wasn't any sell reaction to this. And if the opposite was true, it was all accumulation reaction to it, then the market makers are aligning to show and understand that this is going to be a larger pull up so they can ride that they can day trade that pull up all the way up to 90, 50, 91. But this case, it wasn't that. So I hope that really provides some insight and thought process on that. There's a similar example to what happened yesterday on an uptrend. It's the same idea, both downtrend and uptrend. So I'm going to post another XOM trade sometime, but just wanted to get this one out there. Thank you all for listening. If you made it this far, appreciate. Leave a like, comment. It does help a lot, and appreciate it.